the environment that the industry operates in now, the pressure that it has to put up with is here to stay. I don't think you're going to see a relaxation of the investors' interest in greater transparency, in regulators and other stakeholders' interest in this industry. This industry is a very important element of the capital markets in the U.S. and globally.
Primarily as a function of the economic crisis, as well as the changing investor base that has happened with alternative investment funds. I think what we've seen is both investors pushing for more regulation and institutionalization of the alternative investment funds, as well as legislators and regulators pushing for more tax regulation.
There is clearly enhanced regulatory pressure on the asset management industry. From a tax perspective, we see a lot of focus, for example, from the IRS. We're seeing an increased number of audits. Because of that, there is an increased focus on documentation, managing risk, and making sure that funds are getting ahead of that as much as they can.
When we talk to clients, we hear that there's a lot of pressure on them these days. More than ever, they're focused on growing assets and delivering performance, as well as delivering confidence to investors and regulators. It's not one or the other anymore. They need to deliver both performance and confidence in a balanced and sustainable way.
Anytime we look at a change like this, you kind of go through what used to be 3 pillars, and those were, people, process, and technology. I think the other thing that's been added now is the issue of data. Okay, it's the people, process, and technology and data, and the ability to move data, to have data that is going to be, clear, concise.
We see a lot of firms these days in particular trying to do more with less. Resources are tight, and they're looking at the tax function and they're saying, well, where can we continue to make improvements? They're looking at technology to try to make technology work more so they could actually produce more volume, and they could actually furnish the reports and get information to the various stakeholders, whether it be the investors that need more information or whether it be management that needs more management reports as it relates to the inherent tax risk.
It's a dynamic time for these firms. So many of them have long outgrown the original platforms that they established themselves on, both technology platforms and people platforms. And they're adding people because every business is people dependent, even these. And so as you add people, you add complexity. You add the need to focus on people management issues, HR issues, compensation issues.
So they've adopted policies and procedures and controls and then tests to make sure that those controls are effective. And they're now implementing their policies, procedures, their controls. They're in the first phase. The next phase for these firms will be really making sure that those policies and procedures work, making sure that they're testing those policies and procedures, and making sure that they're really detecting any compliance problems.
It's a much more competitive landscape, and in order to continue to compete in that competitive landscape, infrastructure has become much more relevant. I think managers are trending towards trying to create the most efficient operating environment that they can, leveraging more technology, outsourcing things that they can outsource, because the cost of doing business continues to go up. And so as they do that, that's causing changes in their organizations. It's causing the need to focus on control environments and infrastructure in a manner that, frankly, is at a higher level than perhaps they had to in the past.
And you can make all the best investment decisions in the world, but if you're not managing your operations effectively, you could have a significant, detrimental impact.
There's nothing more important than making sure you're ready for the regulatory scrutiny that managers are expecting. At the end of the day, regulatory risk equals reputational risk. And so it is the top priority of many managers these days to ensure that they are building the right control environment to withstand regulatory scrutiny and, frankly, to meet the expectations of institutional investors.
The SEC, when it comes in to conduct an examination of your firm, fully expects an operating compliance program that is effective, that is doing its job, and frankly, the ramifications for not having a strong compliance program from a regulatory perspective can be quite significant.
I think if you are not prepared for impending regulation or the expectations of the various different constituents, I think you're going to put yourself at a competitive disadvantage. And I think as investors are speaking with potential firms to allocate assets to, the expectation is that you're going to present them with a very robust risk and control framework.
Insider trading, I mean, in the headlines almost every day. It continues to be a focus area. How are investment opportunities allocated amongst client or fund accounts? That's a high priority issue. How does the firm describe its conflicts of interest? A key regulatory requirement, and one that regulators will continue to be focused on.
If funds don't manage their international tax matters properly, there's different types of risks. Clearly, there's a risk with respect to potential reputational risk in a country. At the same time, if a fund is unaware of potential tax liabilities, there's a risk to the investors that the investment return may be significantly lower.
The biggest trend that we're seeing right now is a fundamental change in the way the tax function operates, both how it operates as well as how the organization looks at the tax function. Now what's happening is we're seeing a migration, and at least as much of the tax director's function right now is focused on risk management as opposed to tax planning. There is much less room for error or surprises to investors, to regulators, to legislators, and therefore the tax function is focused on risk management, and the broader organization is now looking at taxes as a fundamental risk that needs to be managed, similar to valuation risk and other risks in the organization.
Now what we're seeing, tax directors want or need more granular information. They're asking much more robust questions associated with, tell me more specifically about the underlying facts associated with the particular debt instrument. Tell me about the expected rate of return. And ultimately, they're gathering a lot more facts to support the particular tax position.
I firmly believe that to be fully effective, a compliance program and the culture of compliance and the fiduciary obligation really needs to be appreciated from the top on down at firms. Can't just be the chief compliance officer who's trying to sell the compliance program.
It's technology, it's people, it's knowledge. All of those things factor into successful compliance. None of these things happen in a vacuum. So it's important for people inside the organization to understand the business and understand what happens throughout the year, and not just look at it at the end of the year.
We spent a lot of time talking about institutional investors, and clearly they've been the source of significant growth for the industry. But longer term, we also think retail investors will have demand for alternative strategies. The same challenges that institutional investors have with underfunded pensions and demographic changes will drive demand by retail investors as well.
So I think for 2013, managers are going to continue to need to react to the changing investor base. And the investor base is clearly becoming far more institutional, and institutions like corporate pensions, private pensions, endowments, colleges and universities, not-for-profits are continuing to want to allocate greater slugs of capital to the alternatives industry.
There's tremendous pressure on the tax departments post-election, tremendous pressure to actually think about the environment and think about how they more effectively plan within that environment and within the constraints of uncertainty. It really starts with where the rates are going to be. And most tax directors are looking at modeling under various different scenarios so they could actually plan accordingly depending upon which way the Obama administration goes. And it really is not only about the fund complexes or what happens inside the management companies, it's about thinking about the various stakeholders.
I think the regulation and the regulatory environment will continue to expand. And I think that the headlines of the day in terms of material non-public information, insider trading, conflicts of interest, all of that is going to continue.
I think in a few years you are going to see alternative investment funds look very different. We've already seen increased barriers to entry for alternative investment funds. The cost of doing business is going up because of the regulatory environment, both tax and non-tax. And I think as we move forward, we will see many more tax functions that have a tax director, that have more people underneath them. I think the days of seeing the CFO being someone who does taxes as a sidelight, you're not going to see those anymore, because it's just not going to be a viable business model.
it's a strong market outlook for the alternative managers. We see it continuing to be an attractive investment option for institutional investors for sure. We see, again, returns and performance to be consistent and continuing to improve. So our view is it's a very strong market, and that's been supported, frankly, by the investors' interest.